Welcome back to Barry Charles, your one-stop shop for everything finance related. In this episode, we're going to talk about shares outstanding. We're going to talk about revenue. We're going to talk about net profit. We're going to give you some of the tools to understand what you should look for in terms of what and dividends. We're gonna look at these four things so you can understand how to start investing for you new beginners out there. Let's get to it. First of all, obviously, shares outstanding. What does this mean? How can it help you as an investor in a stock? Okay, so shares outstanding is basically how many shares are left out that are left not sold, that are on the market to be brought. Yes, this can be millions of shares to billions of shares, all depending on each company. Thousands of shares, just depending on each company. But how does it benefit you directly as a shareholder? Okay, so if you're looking at buying a stock or you own stocks, what positives about shares outstanding? So shares outstanding, we want it to be going downwards generally. You want shares outstanding to go down. Why? Because you own more of the business. For instance, if you have one share in these 10 stocks, and one share in these 10 stocks, you own 10% of the business. Now say they brought back some stocks, and now you have one stock to eight left outstanding. You are now owning 20% more of the business than you did before. Now that is what you want to do in terms of if you want to grow your stake in the company. Next off we have in terms of, there's the downside of shares outstanding, and that's when the company keeps issuing shares, which making you own less of the company. Sometimes it can be a positive if the stock price is continuing to rise, that there's more profit coming into the company. But most of the time, it's just diluting you as a shareholder, and you own less of the company. So shares outstanding. So when you're looking to buy into a company, try to make sure that they are starting to decline their shares outstanding over time. As one positive in terms of buying shares. Now, number two, revenue growth. This is what most people look at in terms of where the future lies for companies, or where the future potential is in companies. So you can have a company that is growing from 1 year to year 0%. Or for instance, they might be negative 10% from last year. Now, sometimes it can just be a bad year, or even negative 50% sometimes. It can be a real bad year, it can be recession, all this sort of stuff. But also it can be just the fundamentals of the business going backwards. This is when you got to do more research into the revenue side. But ideally, when you're looking at revenue, you want that stream of consistency over time. And ideally 10 and more percent is ideal. About 7% is the average, but if you can get once again 10% or more, that's where more and more likely you will get a more higher stock rise appreciation over time if the revenue continues to grow at great rates. And what coincides with revenue is net profit. Yes, the net income or net loss of a company is the next important trend, because you need to be profitable. Just because you have all this revenue, if you continue to lose money, the company is not profitable, and if it never becomes profitable, you will go bankrupt. But yes, if the company starts to get profitable, and continues to get profits, and that profit share improves over time, so it might be 5% to start off with, but it goes up to 7, then 8, then 10, up to 15 to 20% from the revenue, and this is when you start getting into the big moves in the stock market. So net profit is about the revenue minus the expenses gives you what the net profit is, and that's an important metric to learn about. Now, dividends. Yes, dividend. What is a dividend and what is it? It's basically leftover money from the company that they give it to you as a present. That's the best way to put it. They just have excess money, and they decide they don't want to put it back into the business. They believe it's more profitable to give it to you as a shareholder, and you get that dividend every 3 months, every 6 months, sometimes monthly or annually, depending on the company, but most do it every 3 months. and and this way you get money coming back to you regularly, which you can reinvest either into that company or into other companies, or keep it for cash in hand for the future. So these are all the little things you can look at when you're going into investing into stocks. This is very important, and when you're looking at the future of stocks, when you're looking to invest. What's some other little metrics out there that you can look at to see where companies are going into the future? PE ratio. This is one you can look at, the PE ratio of a company. The price to earnings is basically what it's called. So the price of the stock and how much, and how much earnings it's making in between there. So a stock that is just a solid, like a decent stock that's hasn't got super growth in it, in the lower 8 to 12 range. Then if you got a middle sort of growth stock, you're going 20 to 30, and if you're getting above 30 and going up higher, the stock is just looking to continue to grow, and sometimes could be overvalued, or it's got a long way to catch up to where the price of the stock is at that time. So your earnings per share is one way to look at where the company has been in the past and where it could go into the future in terms of, this is the PE ratio part. This is where you can look into that metric in terms of where the future. Other things to look out for, you can look at the total assets versus the liabilities. You ideally want more companies that have more assets than liability, so if they have more assets, they own more chances of stuff that they can sell if they need to in an emergency to pay off the liabilities. That's basically what you're looking at there. And what cash have they got available? So cash is able to either make acquisitions, or that compared to their long-term debt. So you want to be able to have cash coming in that's going to pay off your long-term debt very quickly. This is where you want to look at stocks that have a big gap range between that, and that's when you got to decide whether, should I do that, should I not do that? Just question marks around how that all works for you, and just to make your decision when it comes to all that in terms of where you see the future in stocks there. But just to quickly recap here, we've got you've got shares outstanding, so that's everything to do with the stock in terms of how much stock is available to buy in the open market at any given time. And over time, if the business is buying back more of those shares, it's good for you. The revenue is the growth of the business, how much money they're making at the top line from selling all their products or whatever it may be. And then the net profit is when you take all that revenue and minus any expenses to staff and logistics and cost of things all up. That gives you net profit or net loss. The dividends is all the dividends that you dividends is basically just money they've got left over that they don't want to reinvest, and they give it to you as the shareholder. PE ratio is a chance to understand a bit more about where the company's price of the stock compared to where the earnings are, if it's a good value or not. But anyway, that's just a little bit about some different stock metrics that might help you when you start to build your investing portfolio or continue to build it. Thank you so much for joining me. Remember to like and subscribe to the channel, and have a great day out there.